Right now, as we're wrapping up 2025, a lot of people are feeling optimistic about the markets. Stocks are hitting new highs, the economy seems solid on the surface, and everyone's talking about how things are different this time. But here's the reality. They're overlooking some critical data points. Multiple key indicators are signaling serious trouble ahead, the same ones that warned us before past major downturns. These aren't guesses. They're measurable facts showing building instability and based on historical patterns. A significant market correction could unfold between mid-2026 and late 2027. You've got about 18 to 24 months to get positioned. This isn't about spreading fear, it's about understanding the cycles that have repeated throughout history. Let's start with the big picture. The current bull market kicked off back in 2009, and it's now one of the longest on record. Typical expansions run 5 to 10 years, but this one stretched way beyond that. Long duration alone doesn't cause crashes, but when combined with extreme valuations and high debt levels, it creates vulnerability. Every major crash follows a similar sequence: euphoria and rising prices, ignored warning signs, a trigger event, then rapid unwind. We're deep into phase 2 right now. Warnings are piling up, but mainstream narratives are brushing them aside. History shows this pattern plays out again and again. Take 1929. The market surged on new innovations like cars and radio. Margin borrowing exploded, and experts called it a new era. Then it all came crashing down, with the Dow dropping nearly 90%. Fast forward to 2000. The internet boom drove insane valuations, tech stocks at 100x earnings or more. Margin debt at peaks. Analysts said old rules didn't apply. The Nasdaq plunged 78%, wiping out trillions. Then 2008. Housing prices doubled. Subprime lending went wild. Leverage was off the charts. Officials claimed issues were contained. The S&P fell 57%. Households lost $11 trillion. In each case, overvaluation, excessive debt, and dismissed signals led to collapse. People thought this time is different, but it never is. Fast forward to today, late 2025. The numbers are even more extreme in many ways. The Buffett Indicator total stock market value relative to GDP is around 220% right now. That's higher than the peaks before 2000 and 2008, and way above the long-term average of about 100%. The Shiller CAPE ratio, which smooths earnings over 10 years, sits near 40 again, among the highest ever, compared to a historical norm of 17. The S&P 500 is trading around 6,900 to 7,000 levels, with total market cap pushing $60 trillion against a GDP in the mid-20 trillions. Margin debt is over $1.2 trillion record territory, similar to peaks in past bubbles. When prices drop, margin calls force selling, accelerating declines. Corporate debt is elevated relative to GDP, and a lot of it issued at low rates is rolling over now at higher cost, squeezing profits. Commercial real estate is under pressure. Office vacancy rates are hovering around 19 to 21% nationally, with values down sharply in many areas. Trillions in CRE loans are maturing soon, and banks are exposed, echoing 2008 dynamics. Household debt tops $18 trillion. Credit card balances over $1.2 trillion, with delinquencies rising to levels not seen since the early 2010s. The personal savings rate is low, leaving little buffer. Unemployment has ticked up to around 4.6%, and the Sam Rulin reliable recession signal is getting close to triggering as the 3-month average rises. Manufacturing has been contracting for months, with the ISM index below 50. The leading economic index has been declining consistently, pointing to slowdowns ahead. The Fed has cut rates to around 3.5 to 3.75%, but they're in a tough spot balancing inflation risks with growth concerns. Geopolitical tensions add potential triggers. These aren't isolated issues. Interconnected, high valuations mean any earnings disappointment hits hard. Rising debt service costs erode profits. Defaults in one sector can spill over. Looking at the potential timeline into early 2026, markets could stay elevated as optimism lingers, but as weaknesses mount, earnings misses, rising defaults a spark could ignite stress. Mid-2026 onward, forced selling could accelerate, leading to sharp declines. By late 2026 or into 2027, a major repricing could occur, with stocks potentially dropping 50% or more to revert to historical norms. Valuations always mean revert. Eventually, trillions in wealth could shift from those caught off guard to those who prepared. The key difference between winners and losers in these cycles, spotting the pattern early, reducing exposure to risky assets, building cash or safe havens. In past crashes, those who acted ahead preserved capital and bought low. Those who bought this time, his different story got wiped out. This isn't financial advice, an analysis of data and historical patterns that have held for decades. The indicators are flashing bright red. Valuations are stretched beyond precedents. Debt levels are high. The unwind, when it comes, could be swift. You've got time, roughly 18 months, to review your positions. Stay informed, think critically, and position accordingly. Thanks for watching. Drop a comment if you've seen these signals too, and subscribe for more straightforward breakdowns. See you in the next one.